So in August, I suppose one of the big things that we saw was that investors were concerned about holding risky assets again. So what this meant for markets was that equity markets sold off, gave back a lot of the gains that were made in July, but then bond yields, on the other hand, fell to historical low levels. This was particularly noticed in the AAA government bonds, such as Germany, US and in France and the UK. So for example, the German 10-year government bond yield is now only about 2.1%, which is a level that we haven't really seen before. Well, we have seen increased investor demand for bond yields, and this is something that we've seen through the whole year. So in the flow data that we saw in August, we saw increased demand from Asian investors as well. However, banks and pension funds, because of the regulatory requirements that are coming in, are now being required to hold safer asset classes, which is increasing the demand. So we've seen this in August, where peripheral bonds were sold off and the AAA bonds kind of gained ground. As well as that, there are some concerns that there may be a double-dip recession in the US, but this isn't our core view at the moment. And one of the other big news items that came out in August was that the Federal Reserve said that it would be buying government bonds again. Now, it's not going to do this through quantitative easing like we saw last year. It's going to be slightly different. So it already holds about 2.3 trillion US dollars worth of mortgage-backed securities. And when these securities expire, the government is going to use the proceeds from this to buy US government bonds in the market. Well, the data coming through from the US, it is weaker than people had been expected, but we don't think that it's implying that there will be a recession as yet. The leading indicators are above expansionary territory, so they're still continuing to come in above the 50 mark. Expectations for the release that's due out in September is for continued expansion in the economy. However, there are signals which we think that the risks have increased. For example, the consumer data has been much worse than expected. The unemployment reports have been much worse than expected. So we have seen bigger risks, but it's still not our base case scenario that we'll see the double-dip recession. No, not really. We're probably more comfortable with the level of equity markets that we have now than the level that we had at the start of August. But we continue to see that there will be volatility for the rest of the year. Markets really have to get used to this lacklustre economic environment that we think that we're going to be going through for the next year. And also we see increased risks to the 2011 earnings numbers, although we are comfortable with the 2010 numbers at the moment. Valuations are also quite compelling, but they tend to really just be a support for markets as opposed to a catalyst that could move them forward. We really look for earnings or for economic data to move markets forward.